In terms of our next guest, he's Mr. Joseph Stiglitz. I'm very pleased to say, sir, thank you so much for joining us here today. Now, sir, in terms of the debates here, I mean, it does seem that a lot of the currency debates, a lot of how this recession will play out and how the recovery will stay in place. Are you pessimistic after that U.S. jobs data on Friday?
Yes, I was pessimistic before that. It was pretty much on target of what I thought. And it's pretty clear that the situation is going to continue to get worse. All the forecasts say that. We have about 1% increase in our labor force every year. Productivity normally goes up about 2.5%. And that means if we don't grow at least 3.5%, unemployment is going to go up. And all the forecasts are that we are going to be well short of that. We'll have some good quarters. I think third and fourth quarter of this year may not be that bad, but over the period 2009, 2010, we're going to fall well short of what we need to stop unemployment from growing. It's not a question of lags, it's just not enough growth.
Now, sir, in terms of what we have been hearing, I mean, there's a lot of talk on exit strategies, the fact that we have to talk about them now, but of course not implement them. Dominique Strauss-Kahn was actually telling us that the key figure is jobs. Once those start picking up, it's 3 months afterwards that we have to implement exit strategies. Would you have such a momentum? I mean, would you define when you think they have to come into place?
I think he's been very good about, in a very big change in the philosophy of the IMF, that employment is what we ought to be focusing on. And he's been very clear in saying that the risks are asymmetric. Pulling the money out early could cause a lot more damage than missing it and being a little bit late. And you don't have a perfect crystal ball, and that's why I think the framework of saying let's be sure that employment is going up. Now, one of the important things to realize is that there are ups and downs. So, if employment goes up for 1 month or unemployment goes down for 1 month or 2 months or 3 months, but it's just a little bit, that is not a sign that we're back on track.
So what, 2 quarters? When are we going to start seeing
I think you have to look at a
strategies?
lot of different pieces of data. What's happening to the number of hours, for instance. Right now, the data on Friday, number of hours worked full-time in America is 33 hours per week. That's not full-time. You look at what's happening to the number of people who can't get a full-time job. The broader index of weakness in the labor market, 1 out of 6 Americans can't get a job, a full-time job, or dropped out of the labor force or unemployed. So these broader measures in conjunction with the normal measure of unemployment are the kinds of things that you need to look at.
How is this all going to play out in the equities and commodity markets? So we have had quite a significant rally since March, practically unsupported by fundamentals.
I think that's right, and so that means there's a lot of risk going ahead of some big bumps. I mean, we know that there are problems in the foreclosures, the housing market. The number of mortgages that have been restructured is basically 1 month's foreclosures. We know that there are problems coming up ahead in commercial real estate. We don't know how serious and whether the banks will be able to paper them over, but we know that they're pretty big. We know that problems, if unemployment continues, there are going to be problems in credit cards, and businesses are going to have problems continuing making sales. So when we look at the whole landscape, one has to say that there are a lot of bumps ahead, and that there's a very big risk that the markets have been irrationally exuberant, to use a phrase that was used by Greenspan in an earlier decade.
So does it mean we're going to have a correction? You speak about bumps, but what does that mean? The market is going to fall by 10%, 20%?
I don't do market forecasting. I've really tried to focus on where the real economy is going, and I'm surprised as you are about the euphoria. One of the reasons why the market is up, it's important to realize, is that when the unemployment is very low, wages, when the unemployment is high, employment is low, wages get pushed down, and that normally helps increase profits. Interest rates are very low, and that means people don't want to put their money in T-bills. And so those are a couple of the factors. So it's the weakness in the economy that have helped some of the equity markets to do well, but that's not a sign of a robust economy. One of the striking things about this recession and the magnitude of how serious it is that prices have actually been declining. So the curious thing is that wages, real wages adjusted for inflation, have been going up. Even though wages are very weak, they've been able to keep up with inflation because prices have started coming down.
Sir, just very quickly, is there a risk that these exit strategies won't be implemented in time, and so that central banks will have to raise rates before they're ready?
Well, I think that that's not very likely, because at least in the United States, we have a very time-bound stimulus that comes off in 2011, and the likelihood that we will be out of the woods before that is very small.
Sir, thank you so much. Great to speak to you.